So today's cardinal lesson, it's the fourth video in a series of 8 videos where we're going over the financial plan that we wrote for Tom and Susan. And Tom is 67, his wife is 66. He's an MD, and we've had 3 series. He's retiring. We've had 3 series, 3 videos that we've shot covering the whole thing, what we're doing on the 8 videos. The second one was about Social Security, the third one about Medicare, and today we're on long-term care insurance, long-term care planning. We're showing you the piece of that. We also want this video to stand alone as a lesson on about long-term care and long-term care planning. So if this is the first video you're watching, we want you to get a lot out of it. Tom?
Yeah, we're doing this video because I want you to really plan for long-term care. Of all the topics we talk about, everything we go over, this is going to be the most impactful thing you could do for your family. If you need care, this would upend all the other planning if you don't have a plan in place. We'll get to some examples later. But of everything we do, and I've lived it personally, Hans has lived it personally, this is the hardest thing, one, to plan for and talk about and think about. But if you're going through it, living through it is just extremely difficult. And it's who ends up bearing the burden is your family, it's your kids, it's your loved ones. And so you do this planning not for you, but you do it for them. And so I just want you to take this seriously. If you haven't really thought about it, please watch this, please listen to it, and then we'll get into the examples. You can find, I'm going to bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board that we'll get to in a second. Like Hans mentioned, we have a series that we're doing a series here, 8 videos where we're walking through sort of the process of doing the financial plan and actually showing the plan. In the show notes, we actually have the written plan that goes over that. There's a section about long-term care, these couple pages. We'll get to the numbers here as we go through the board. But look at this, read through the plan. Every plan is different, right? Because everyone's situation is different, but this is sort of the framework we use when we're doing financial planning. So let me turn it back to Hans, and we'll start going through the board here.
Okay. So Tom, 67, almost 68. Susan, 66. She's turning 67 in the fall. Tom is retiring in October. So we've known him for 3 years because he came to us when he was turning 65. He was watching the videos. He knew we're experts on Medicare, came to us. And in the last episode, we put all the planning we've done for Tom and Susan and the insurance, the Medicare supplement insurance, the IRMA planning, all of that kind of stuff we had already done for them. And then they've been watching the videos consistently, and they knew and they've learned that we know a lot about income planning and IRA 401k planning, and they really hired us to do the comprehensive financial plan over all of those things, financial, and being able to pay less taxes, being able to have a guaranteed income into the future. That's what they were sold on, and they very gladly paid us for the financial plan. They really didn't want to talk about long-term care. Because we've brought this up every time we've talked to them, and we've kind of gotten a little bit of a, not a little bit of a, pretty, but it's just like, no, we're not going to, we are self-funded. Okay. They actually said self-insured, and then I was able to move them to a better definition, because self-insured is really kind of, you can't be self-insured because insurance spreads the risk around everybody. And if it happens to you, self-funded just means I'm going to use my own money to pay for it. And that's really where they were. And so we're going to start this video, which I think is more important than going over the plan that we're recommending and the solution, which they're buying. We want to go over, like, what was it that moved them to actually do something about this? So I'm going to push it to Tom, and I want Tom to share with you a little story about Tom and Susan.
Yeah, I think, it is interesting because we run into this a lot when we're doing planning, is they have a current advisor, someone they've worked with, which is okay. Like, we do a lot of planning where we're not taking over the management of the money, but we're still laying out a plan. and we bring up long-term care and they go back to the advisor and the advisor says, oh, you can self-fund or self-insure, you can pay for it if it happens. Which, you could run the numbers and objectively maybe they could. And that's not really the crux of the issue here. And I'll get to an example in a second. But for Tom and Susan, what really changed their mind, what really got them back wanting to talk to us about this, was in between when we first talked to them about this 3 years ago and now, is Susan's mom started needing care. And Susan is having to step up and provide some of that care to her mom. And she's seen what that actually looks like, right? It wasn't that her mom didn't have money and could pay for somebody. She was just unwilling to do it. She didn't want to pay somebody. And so who she taps on the shoulder to come help is Susan and her siblings. And we see this play out. I could spend the whole day talking about story after story where we see this play out. And it's awful, right? I mean, it's hard, it's emotional, it's literally very difficult work at times, picking up, moving people around if that needs to happen. I mean, it's just an awful situation to look at. And Susan saw what that was doing to her, what her mom was going through, what that was doing to her and her family. And she's like, there is no way I'm putting my children through this. And that's really, once people understand that, that's really what gets them to move on planning around this. And so, again, if you've never been through that, you don't have that experience, learn from other people's experience, right? I mean, and I've been through care needs myself, right? My wife had to take care of me, and it's just hard work, and we were young and healthy, right? I mean, it's just difficult. And you imagine you being, in your 60s, if you're the adult child taking care of them, or if you're a spouse and you're in your 80s trying to take care of a spouse, it's awful. Let me give you one more story just to sort of drive this point home. Is we're dealing right now with one of my friends his grandmother is the one needing care. And so she's, gone into the hospital, been sent to rehab, which is pretty typical, but it's becoming more and more evident that she's not going to be able to go home. Like she's going to have to stay in this rehab and it turn more into a long-term care type situation. Medicare is right at the point that they start kicking them off, right, where they stop paying for the care. Again, we can dig into that a little bit, but I mean, Medicare will pay for up to 100 days. The critical comment in there is up to 100. Most times it doesn't last that long. You get to about day 20, 21, they start trying to say, hey, we're going to stop paying. Again, there's reasons for that I don't want to get into today, but they're right in that moment. And now my friend's mom is the one stepping in, trying to help coordinate stuff. And luckily, the grandmother had a long-term care policy, so I'm trying to work with them, help them walk through how that claim process looks. And the mom doesn't really understand it. She's confused. She's upset that it's not paying more, right? I mean, it's only paying $150 a day. What is this? Like the cost is $400 a day, which again, the cost is what the cost is, and her benefits are, but that means she's not having to pay $150 she would otherwise. So we're trying to walk through all that. And then we get to the point where it's clear like the long-term care is not going to cover all of it. She's got a pension, she's got Social Security, that takes a chunk out of the bill too, but there's still a leftover amount. Luckily, grandma has, $1.5 million of investment. She has money, right? And this gets to that question: if I can self-fund this, she's got the money there. And guess the first place the mom's going to think about how do we raise this money? Do we need to sell the house? Was the comment she threw out. It's like, wait a minute. Why are we wanting to go sell the home? You have money here. From tax reasons, it doesn't make sense to sell the home. You're missing out on the step up in basis, all these different things. But that's where people go to, right? I mean, it's in crisis mode. They're not thinking logically because at the end of the day, she's got the money to pay for it, but she's not the one making the decisions, right? It's the kids making the decisions. It's stressful. It's hard. You don't make good financial decisions. What a long-term care policy does is you have the funding taken care of. It's like, okay, if I need it, I have this policy to turn to, and my kids aren't having to figure out where are we getting money from. And so even for the people who have enough to self-fund, it's still important to plan for it. It's still important to have a plan in place. We're proponents of using long-term care to do it because you get the leverage from the insurance company. There's tax benefits Hans will go over in a second. But again, I think having something there, having thought through what this looks like, really prevents your kids from having to go into crisis management and start doing rash things to try to pay for whatever the care needs. So again, I could go on and on, story after story. Those are just a couple examples, but learn from other people's experiences, right? If other people who've lived through this are the ones that are wanting to plan for it, think about that and say, okay, do I want to put my kids through that? And I can just tell you right now, you don't want to do that. Your kids are still going to be involved, but you don't want them being the ones giving the actual care day in and day out. So, Hans, let me turn it back to you and we can go through more of the things that brought them back to plan for this policy.
Yeah. I mean, being self-funded or self-insured, frankly, is where everybody is until they buy long-term care insurance. I mean, that is your plan by default. And I agree with most people that tell me I'm self-insured and I'm self-funded. I got enough money. If this happens to me, I'll pay for it myself. And my answer to that is, okay, you do have enough money, and you will pay for it yourself. And the real question is, do you want to do that? Does that make sense? Is that, and so just think about that for a little bit. And as far as Tom's story, Medicare is going to pay a little bit on the front end of most claims. I mean, most people, because you get out of the hospital when you're up there in years and you've had something where you've been in the hospital for 6, 8, 10, 12 days or whatever, they can't send you home. They push you to rehab, which is another term for nursing home. And most people in rehab, they get skilled care versus custodial care. And but it doesn't matter what you call it, is when you get downgraded from skilled care to custodial care, that's the point at which Medicare is going to cut you off. They may not kick you out of there, it's just Medicare is going to quit paying for it. So the answer on the Medicare thing is it's going to pay a limited amount, maybe help with your elimination period or waiting period on your long-term care insurance, or maybe give you a little time to dip into your own resources. So what I want to get onto is that this couple, Tom and Susan, they were described self-funded, and really Tom and I were saying to ourselves is that self-funded with a lot of people, or self-insurance, is just a way to keep the conversation at bay. Who wants to sit around in their retirement, especially people with a lot of money, and think about long-term care, nursing home, all that kind of stuff? I'd rather not think about it. So I'm just going to, before I dig into it, I'm just going to say I'm going to be all right. I'll just use my money to solve the problem. And that doesn't look very good 20 years from now. So what moved Tom and Susan, and Tom already gave you the answer to that, is Susan's mother had an incident, which is kind of, they were still self-funded, and Tom's over there, well, that happens to us. In fact, they're going to inherit money from Susan's mother, so that the money's going to compound, making them even more self-funded. But it opened the door a crack. And so we went through a process, and then them hiring us to do this financial plan, which they weren't looking for long-term care. It gave us a chance to really have some discussions like we're doing on this video. And I can tell you the effect on their kids and on each other, on the healthy spouse, is once people take a look at that, is like if I all of a sudden had a stroke at 80, and now I had the option to come home. The only reason I have an option to come home is I've already spent 2 weeks in the rehab, is because my wife is going to be there and she's going to somehow try to provide me the care. But we're going to be hiring an agency, and that's going to really in effect be a privilege, where now I'm going to be back home, live my life, but I'm certainly not going to be dependent on her to be a full-time caregiver, because she's going to be 79 when I'm 80. And plus she has a life. So the insurance comes in, where if the insurance company's paying for it, all parties are going to be all for collecting it. And when you start bringing the kids in, and people start thinking about that, when all of a sudden Tom and Susan's kids are in the same situation Susan's in right now with her mother, people start thinking about that. I don't want my kids to have to disrupt their lives. I'm certainly hoping that they come visit me regularly, and I think they will. And we're going to communicate and bring the grandkids around. But do I think they're going to come and take care of me, or do I want that? And the answer is no. So the effect on the whole family is really the number one reason that Tom and Susan started looking at this seriously. And then we're going to jump over to the tax-free benefits. So when I dig back into the self-funded, and you start thinking about, okay, so I'm going to have to pay this 10 grand a month, or 12 grand a month, or 8 grand a month every month for years, and I'm going to have to pull that out of my assets, what's that going to look like tax wise? I mean, how much, to get 10 grand a month, I'm going to have to pull out 16, 18 grand out of my IRA to be left with 10 to pay to pay the assisted living bill or the home health care bill. So what am I going to have to sell? Am I going to have to sell assets that I otherwise wanted to pass on to the kids? Am I going to have to disrupt charitable giving? I mean, there's just a whole bunch of stuff around taxes that was really influential with Tom. Yeah, Tom Griffith, you want to respond to that a little bit?
Yeah, I mean, I think one of the things when you are self-funding, that means you have to sell investments. Presumably, it's probably not all sitting in cash. When this time comes, when you need to pay for the care, what will the market be doing at that time? Who knows, right? The market's not sitting around waiting for the perfect time for you to need care. The care is going to happen when the care happens, regardless of what's going on in the economy, right? It doesn't matter. And the worst thing that could happen is that happens right when we're in a downturn. Now, is that likely? I mean, who knows, right? We don't know when the care, and that's just it, is you just don't know. And so let's say in the best case scenario, markets are up. So you're not selling at a low point, you have the money to pay for it. Now we got to deal with taxes, right? So now you got to sell the investments. Are we pulling it out of an IRA? Are we pulling out of non-qualified accounts? If it's non-qualified, you're dealing with capital gains. If it's coming out of a traditional IRA, you're dealing with ordinary income taxes, driving up your AGI, which has a lot of impacts across the tax return, right? IRMA is one of them. Tax rates are higher. I mean, it has huge impacts there. So now maybe we get the money to pay for the healthy spouse, or the sick spouse, but the surviving spouse, the healthy spouse, they're having to pay a higher cost for their Medicare. They're having to pay higher taxes. They have less money to do what they want to do and live their life. So it's impacting them, and you're drawing down the inheritance, right? And unfortunately, I've seen many cases where kids step in, they're the ones managing this, and they start skimping out on the care, right? You kind of hope that's not the case, and a lot of times it's not. But certainly, you can I sit across the table from them, and they're like, well, do they really need that? Can we sort of get by on this, right? And really, what ultimately is in their eyes is we're spending our inheritance now, and we don't want to. And you don't want to put your kids in a position that they have to pick between those two situations, right? Now, I would say more often than not, kids are willing to do it. They want to take care of mom and dad, but it's not all the time. And so again, self-funding is an option, and like Hans mentioned, that is your default option without a plan in place. But I think again, this is a better way from a tax perspective. It's a more known quantity. You know what you're dealing with. You're not worrying about market timing, and you're not worrying about taxes if the need arises.
Yeah. So the tax-free benefits of the money coming out of the back end of the policy that can go on for years is all tax-free. And that's huge. And by the way, is if Tom and Susan are self-funded 20 years from now, it's not going to be Tom or Susan selling the assets. It's going to be their kids. And now we're back to the thing is that's who's going to be dealing with your money when you're 85 or 90 and collecting on these policies or doing your self-funded thing. It's not even going to be you doing it. It's going to be your adult children in most cases. So the third deal is that really convinced him to do this is the example we're going to give, we're able to purchase it with a lump of IRA money. The IRA money's just been sitting there, untaxed, growing, which is a good thing. Now he's retiring. He knows that minimum distributions are in the not too distant future. And so we can buy this with a single premium, one time, never to pay again, with a transfer from the IRA where it is now into an IRA at the insurance company. And then there's a whole bunch of stuff going to go on after that. The fact that he could do that really perked him back. I already talked about RMDs, is that there's an element within this, we're going to show you in a minute, where there's going to be a money coming out of that IRA every year to pay for the policy for 10 years. That money coming out of there counts toward your RMD when you ultimately get there. It has a death benefit, so it's going to share that if they put this 300,000 in there, it's over there in an IRA. Then we deplete that and put it into the long-term care life insurance hybrid policy. and then we never use the thing for long-term care, then there's going to be a life insurance benefit that's going to go to the kids or the heirs afterwards. So all is not lost if they don't end up not needing the long-term care. And then the last area is really an emphasis on the home health care benefits. People that have resources, they have a nice home. There's two of them around now. Maybe when this happens, there might only be one of them, but nonetheless, people generally want to stay in their own home if it's at all possible. I know in my own personal plan, I'm going to go to the assisted living kicking and screaming. I want it all to happen right here at home, and I don't want my wife to do it. I want the insurance policy to pay the home health care agency that's going to come in and take care of me. And once we explained all of that to Tom and Susan, this all made sense. Tom?
Yeah, I mean, I think at the end of the day, all these six are sort of the reason that they were considering it. But again, taking us back to number one, which really is the most important one, is the impact it has on your family, kids. Like you do this planning, you buy insurance like this for them, not for you, even though you're the one receiving the care, right? It's protecting them from that. All the other ones, in my experience, are ways to help justify it. Gets you a little bit more excited about it. You can start making justifying your mind why you want to do this. The numbers need to work, right? So don't get me wrong. The policy needs to make sense. It needs to be part of a larger plan. We can't just throw a bunch of money at this if we don't include it as part of making sure we're not limiting the amount that you have to spend. So again, it needs to be part of a larger plan. But at the end of the day, it's the kids, it's the family. That's the reason that a lot of this planning got done, specifically with Tom and Susan here. And so what we're going to do sort of the next portion here is walk through the actual example. Like we have the example, what we recommended for Tom and Susan. Like Hans mentioned, it's using IRA money, which is unique to this company. And so what's nice about that is that's where a lot of people's savings are, right? That it's in the IRA, it's in the 401k, money that hasn't been taxed yet. They don't necessarily have a plan for it. And so that's what we really are going to do here. I do want to show that in the show notes of the that we went over a little bit earlier, at the very bottom of the show notes, we actually have the proposal, the full proposal of the long-term care plan. It's here. If you want to look at more of the details, we got page by page. A lot of these numbers are represented on the board here. So I'm going to turn it back to Hans and he'll go over highlights, but just know the full proposal is in those show notes right at the very bottom. You got to scroll through a bunch of pages, but we're down at the bottom is the show notes for this long-term care policy.
Okay. So just getting back to our whole picture of what we're doing for Tom and Susan is we're preparing a comprehensive financial plan that covers the 7 areas that are on the board here. And specifically today, we're talking about long-term care. And then now we're moving into the recommendation of this is the policy that we're recommending Susan and Tom purchase. And they're going to. And we're touching a few of the other areas because we're using IRA money to purchase it. The $300,000 that's going to buy this policy is coming out of the IRA. It's going into another IRA, but it's coming out of there. And there's also a little bit of a tax effect. And so we're touching a lot. So I just want people to understand this recommendation is in light of everything we're doing for them. Okay, so let's talk about why would you want to do this? What are the benefits? If one of the two of them went in an assisted living tomorrow, or they had a bad accident and tomorrow they're going to need home health care, somebody's going to come in, and right now in 2026, their monthly benefit for either home health care or assisted living, nursing home, adult daycare, $6,864 a month. Okay. Now, that would be paid out immediately. Now, next year, 12 months from now, that 6864 would go up by 3%, and 3% the next year, and 3. So it has an inflation factor on there that lasts 20 years. So that's going to get them to 87 and 86 before the inflation stops. And when we are 20 years from now, in the year 2046, their maximum benefit is going to be 148,000. Okay. And the monthly benefit is going to be 12,397 a month. So when they're actually using this, the point I wanted to make, most likely they're going to get more than $6,800 a month out of it. So it had, the benefits go up over time. There's no increase in the premium, or there's no changes in the premium for that. That benefit, as we said earlier, comes to you tax-free. So you don't have to pay taxes on that. And, the overall maximum on the policy, on this particular policy, is impossible to state because there's no time limit on it. In other words, Susan could develop dementia at 75, start needing home health care at 77, and she could still be living in an assisted living at 97. And for those whole 20 years, this monthly benefit would be paid out to them. So it's unlimited in that aspect. And the whole time, she's also not using up Tom's benefit either. So Tom's over here. If he needed care, his benefit is the same as hers, even if they needed it at the same time. Now they're paying out two benefits. The important thing to understand is the whole thing doesn't have an overall maximum or a cap on it. It could go on as long as you're alive. That's one of the reasons we favor this company. And because most people buying long-term care insurance are looking at, if I use this, there's a high chance that, that dementia or Alzheimer's or something with memory loss is going to be involved. I don't want a time frame because I may outlive my long-term care policy. That can't happen with this. Now, the death benefit on this policy is $433,552. Okay. And what that means is if Tom and Susan never used it, and they both were killed like quickly in a car accident or something like that, their heirs would get paid $433,000. Part of that is just sending their IRA money back to them, to their kids. And then part of it is the actual death benefit in the life insurance portion of the policy. So I don't want to get too detailed. If they die after the 10 years, so they die, both of them die 77 or after without using it, the death benefit on the policy is $164,000. So, but the death benefits are not really what you're buying for. That's just like a refund feature back to your estate if you didn't use it. So I want to push it to Tom. I want Tom to just talk a little bit about those benefits before I get into this.
Yeah, I mean, I think, one of the questions that we'll get often is this enough, right? Is this going to pay for all possible levels of care? And the answer is probably no, right? I mean, care is expensive, and we don't need to insure the whole risk. But, if we were to need care, and let's say we were needing it, I don't know, 15 years in the future, somewhere around there, and you're getting 10 grand a month, you know, albeit the cost is going to be higher 10 years from now, right? It's going to be more expensive, but that is still going to be a very meaningful amount of money coming in that's not coming out of your portfolio to help cover that cost. And so, does it cover everything? Probably not in all scenarios. Does it cover a lot of care? Absolutely. I mean, it's very meaningful. And again, not everyone can afford 300,000, right? So that's where the planning comes into place, right? Is we need to look at the assets that you have. We need to look at sort of your income because we can't put money aside that's really earmarked for long-term care if it means you're not able to live and do the stuff you want to do now. So there's always that balancing act. And that's again why we would like to do this as part of a larger plan, as opposed to just focusing in on one area like long term care. But assuming we've checked all those boxes and we can set some money aside, getting that leverage of lifetime benefits, that literally there is no way that you could do that by self funding. Like there is no investment out there that would produce an unlimited amount of money to pay for care at the level that we're talking about here. And so, especially in those longer situations of care, 8, 10 years, typically that's memory issues, dementia, Alzheimer's, those type of things. You couldn't self-fund that. There is literally no way you could do that. The long-term care policy is nice that it covers that. And the other thing that we like about the lifetime benefits when we have a couple, especially, is one spouse is not worried about using up the other spouse's benefits, right? I mean, we had a couple last year that was going through, the husband needed care and he had sort of forgotten the specifics of the policy. He had the lifetime benefits, He did not want to start the care because he said, I don't want to use up my wife's benefits. I mean, he was very firm on that. We had to remind him, like, listen, I understand that you're looking out for your wife, you love her, which is great. However, your policy, you literally can't, right? It's unlimited. You can't use up her benefits. You need care now. Let's bring some people in to help take care of you. And so it just removes that concern from a couple with having that unlimited benefits. Now, does everyone need unlimited benefits? No. I mean, there's a cost there, right? I mean, if you got a smaller policy, it lasted less amount of time, it would cost less. And that's where building it through sort of a plan is helpful, is sort of fine tuning what that looks like. But again, this made a lot of sense in their plan. Back to the earlier comment, is they were wanting to do this because they saw what that looked like when they were taking care of Susan's mom, and they didn't want to put their kids through it. So again, it fit well with them. They were still healthy enough to qualify, right? But that's the other piece of it, is some people say, oh, I like it, but I'm going to wait. I'm going to put this off 5 years and I'll be ready to do it then. You might not be able to do it then, right? The bigger, I mean, it's going to be more expensive by waiting, but that's not the bigger issue. The bigger issue is you could get sick between now and now you might not be able to get it because there is underwriting. It's not as strict as some of the policies out there, but it's still pretty strict, right? You can't have real serious stuff going on. They'll just say, this policy particularly would just say, we're not going to take you. Now we have other options available, so we're not going to get to that in this show. We have other videos on that. But just know the cost of waiting is there's a risk that you couldn't buy this in the future, just literally because your health prevents you from doing so.
Okay, so now I just want to go over what we do with the 300 grand. So your 300,000 for Tom and Susan is over in their IRA. It's part of an excess of $1 million. They have a pretty large IRA. And so that's going to be done by custodian to custodian transfer over to an IRA at the insurance company. Okay, that $300,000 is there to fund the long-term care life insurance policy. The insurance company is going to add $75,000 of interest to that, which makes a total of $375,000. And the $375,000 is going to be transferred out of there year by year for 10 years. So that equals $37,500 a year for 2026 through 2035. Each one of those 10 years, there's going to be a transfer from the IRA of $37,500 into the long-term care life policy. And that transfer is going to be complete at the end of 10 years. So the value of this IRA 10 years from now will be zero, and all the money will be transferred into the life long-term care policy. And it's that policy over here that produces all these benefits. So this is what you're after. And what this does is spreads those IRA distributions out evenly over the next 10 years. And so when Tom turns 73 and he has to start RMDs, he's going to have $37,500 of his RMD made every year for him. And that's going to last another, 4 or 5 years. And then that'll all be complete. So there's a bunch of accounting that needs to go on. And there is going to be a tax bill that they're going to have to pay the taxes on that $37,500. When you look at the whole financial plan that we're going to get to in the subsequent videos, this will be accounted for. All of this will be accounted for inside of the financial plan. So you're going to actually be able to go in and look at it. So what I want to do is just position all this again in terms of, that's what we're doing the 8 videos on. This is the 4th one about the financial plan for Tom and Susan. This was the recommendation for them. And we've done Social Security for them. Their Social Security checks combined are over $6,000 a month. We talked about Medicare in the last one. We talked about a little bit about Medicare in this one, long-term care. And then we're using IRA money to fund this thing, but we're not distributing it all at once. We are creating an income, and we're taking this into consideration because when we get to the 6th video, we're going to get into the income and investment plan for Tom and Susan, and this will all be mixed into that. As far as estate planning, this thing has a death benefit. So if people think, well, I'm going to go through my whole life and not use it, what do I get back out of it? Well, you get a life insurance benefit. And then we've already talked about taxes. Everything we do, especially when we're doing a financial plan, all has a tax effect. And the real benefit of these financial plans is not like the recommendation we did in one area. We mix all 7 of these things together in the recommendations, and then we predict out into the future. We make projections of these things all bouncing against each other. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.